Ladies and gentlemen, good day and welcome to the Prudent Corporate Advisory Service Limited Q3 FY2026 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rishad Kapadia from ICICI Securities Limited. Thank you, and over to you, sir.
Thank you. Good evening, everybody, and welcome to the Q3 FY26 results update call of Prudent Corporate Advisory Services Limited. We have with us from the management of Prudent Corporate Advisory Services Limited, Mr. Sanjay Shah, Chairman and Managing Director, Mr. Sirish Patel, CEO and Whole-Time Director, Mr. Chirag Shah, Non-Executive Director, Mr. Chirag Kothari, Chief Financial Officer, and Mr. Parth Parekh, Head of Investor Relations. Now we would request the management to start with the opening comments, post which we can open the floor for Q&A. Thank you, and over to you, sirs.
Thank you, dear, and good afternoon to everybody. I extend a warm welcome to all of you for joining the Prudence Q3 FY26 earnings call. Thank you for taking time to be with us today. I hope you have the investor presentation handy, as we'll be referring to it through the course of this discussion. So now straight away, let us move to our slide 45, which talks about the momentum in our AUM growth. So if you look at the slide 45, it shows how our AUM has moved during the quarter. On the left hand, you see a comparison of daily average AUM for first 9 months of FY26 with an AUM as on 31st December 2025. During the first 9 months, we earned revenue on a daily average AUM of 1,19,000 crore. Our opening AUM for the current quarter stands at around 1,30,000 crore. That's an increase of about 9.2%. This gives us a strong momentum as we enter into the last leg of FY26 and the FY27. In the current month, the broader Nifty 500 index has corrected by around 5%, and consequently, our current AUM stands at approximately 1,26,000 crore. While the month was challenging from a mark-to-market perspective, we saw strong resilience in net sales. Our equity net sales for the January have crossed 1,200 crore as of yesterday, which has helped cushion the impact of market volatility. SIP addition has also remained robust during the month, with our SIP book increased from 1,170 crore compared to 1,130 crore in December 2025. On the right-hand side, we have quarterly average AUM trend. The average AUM for the quarter was 1,27,600 crore. Our quarterly average AUM grew by 21% year-on-year and 7.2% quarter-on-quarter, reflecting steady and sustained business momentum. Now please move to slide 46. It talks about the equity AUM movement. So this slide shows the movement in our equity AUM on a both year-on-year and quarter-on-quarter basis. Starting with year-on-year view on left, our equity AUM grew by 22.4% during Q3 of FY26. It moved from 1,02,700 crore in December 24 to 1,25,700 crore in December 25. That's an increase of nearly 23,000 crore. Two-thirds of this growth was driven by strong net sales and acquisition of Indus, and the balance one-third has been contributed from mark-to-market gains. Coming to quarter-on-quarter view on the right, equity AUM grew by 6.9% during the quarter. This was driven by mark-to-market gain and a strong net sales of 3,454 crore. Now please move to slide 47. This slide highlights our SIP performance. As of December 25, our monthly SIP book stood at 1,135 crore. We have added almost about 200 crore over last 12 months. Currently, as stated, this book has grown to 1,170 crore. Our market share has improved by 20 basis points from 3.3% in December 2024 to 3.5% in December 2025. We aim to cross 1,200 crore in monthly SIP flows by March 2026. Now let me take you to the last slide, which is the consolidated financials. So slide 49, which outlines our consolidated financials. So on the mutual fund side, our quarterly average AUM grew by 7.2% sequentially, while the mutual fund revenue has increased by 8.2%. The mutual funds revenue grew at a faster pace, led by an extra income to the tune of 1.4 crore due to release of withheld brokerage following some relaxation in KYC norms. Excluding this one-off income, our yield were stable on a sequential basis. On a 9-month basis also, quarterly average AUM and mutual fund revenue grew hand in hand at a 20% and yield have remained more or less stable on a 9-month basis as well. On the insurance front, our premium grew by 13% sequentially, led by a good uptick in our LI vertical. However, revenue grew at a slower pace of 3.6%, primarily driven by the rationalization of rate post GST changes in the retail health vertical. As stated in the last call, most of health insurance have reduced the rate by 18% from 1st October 2025 onwards, following the reduction of GST to a nil rate. So, the quarterly revenue from operations grew at a pace of 7.3% sequentially. On a 9-month basis, revenue were higher by 16.6%. Operating expenses also grew at a similar pace of 7.2% sequentially. During the quarter, employee costs included one-off provision of 1.49 crore related to implementation of new labor code. In addition, there was an ESOP charge of 1.61 crore for this quarter, and it will remain the same for next 3 quarters, as an annualized cost for ESOP would be in the range of 7.2 crore. After incorporating these items, operating profit for the quarter grew by 7.8% sequentially. On a 9-month basis, operating profit is also increased by 12.2%. The increase in finance cost of 92.32 lakhs, please look at the finance cost segment. So increase in finance cost of 92.32 lakhs is attributable to accounting treatment of deferred consideration payable to Indus Capital. Deferred payout is recognized at its discounted present value and periodically recognized as the finance expense. Accordingly, interest accretion of 92.32 lakh rupees has been charged to PNL. Please keep a note that these costs will continue to be recognized over next 11 quarters until the full deferred consideration is paid to Indus Capital. So this 92.32 lakh rupees every quarter will have been added into the finance cost. You'll see that as an additional cost item. Another change related to the depreciation. Since the acquisition of Karvi in November 2021, we have been depreciating the acquired assets over a 10-year period. Now that the acquisition has completed over 4 years, we were able to demonstrate based on operating experience that the assets are long-term in nature. Accordingly, in consultation with our auditors, we have revised the useful life of these assets to 15 years, extending the depreciation period up to November 2036. That means from here onwards, now these assets will be amortized over next 11 years. Consequently, amortization expense for the current quarter has reduced to an extent of 1.7 crore, mainly on account of Karvi assets. Additionally, acquisition cost of Indus Capital will be amortized over a period of 15 years. So overall, reduction of Karvi depreciation and additional depreciation cost of Indus, overall depreciation figure has modestly increased from 7.7 crore to 8 crore. Despite utilization of 87.3 crore from the treasury book towards the Indus Capital acquisition, our other income grew by 16.4% sequentially. This was driven by positive mark-to-market gain on the equity-oriented treasury investments, supported by a 7% rise in Nifty 50 during quarter ended on December 25. A stable operating performance has led to a net profit growth of 7.6% sequentially and 19.6% on a year-on-year basis to 57.6 crore. On a 9-month basis, net profit grew by 13.2% to 162.9 crore. Now I'll try and touch base the merger of Indus. So the merger of Indus acquisition is working very well for us. We now have completed 2 meetings with all the big clients, and there is a significant comfort regarding the integration with Prudent. It's a highly cash-accretive addition to our platform, powered by 15 experienced relationship managers under a seasoned business head. Given the successful integration and experience, we are in lookout for similar opportunity in this space, wherein distributors are seeking alignment with scale technology-driven platform to ensure business and service continuity for their clients. A space where Prudent is well positioned and open to exploring strategic opportunities. And our treasury corpus of 537 crore provides a robust war chest to pursue such opportunity. Finally, touching upon SEBI's recent changes in the total expense ratio. Now, first point is about the revised expense ratio, which will now be exclusive of all statutory levies, including GST. Earlier, only AMC's management fee attracted GST over and above TER. Everything else was considered inclusive of GST. So let us assume if I was earning 1% from AMC, that 1% was inclusive of GST, meaning my actual income was 85 basis points and 15 basis points went to GST. Under the new structure, my rate will be 85 basis point, exclusive of GST, so I'll invoice GST on top of that and still effectively I'll earn 1%. So more or less we believe it's a revenue neutral for those who are registered under the GST, but the big advantage which will accrue to Prudent is that it removes the earlier anomaly, where a GST registered distributor used to earn less than an unregistered one. This really creates a very strong level playing field for us, and it helps us attract smaller players to join Prudent platform. So even though it's a neutral in revenue terms, it's strategically very, very beneficial to us. Second point in the entire circular is related to removal of 5 basis point benefit, which was available in lieu of exit load since 2012. This benefit was available over and above the regular TR, which has now been withdrawn. This 5 basis point represent a cost for the entire industry. So while a part of this impact will flow through to distributors like us, the exact sharing mechanism between AMC, distributor and other stakeholders will become clear only by April 2026. So I think with that, I'll just close my speech and I'll open the floor for the questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Niranjan Kumar from Avendus Spark. Please go ahead.
Thank you, sir, for giving the opportunity. Sir, first, on the SEBI recent changes in the TERs, like I wanted to ask, has any AMC initiated any negotiation on this yield cut? Also, like, to go sometime in the past, like when upfront commissions were removed around 6-7 years back. So how is shaped then? Like who took the major hit then? Is it AMC or distributor like Prudent? That's the first question. Second question, sir, the MFD market share has been declining for a few quarters. Like even in this quarter, I think it declined by around 200 basis points. So what's happening really there? Like, are we facing any challenges internally, or the competitive intensity in the industry has increased, like where other players are giving aggressive payouts? So these are my broader set of questions, sir.
Finish.
So, coming to the first point, whether AMC have started discussion about the passing on the TER cut, the answer is no. As of now, no AMC has started the discussion about the passing on the TER cut. My guess is that by mid of March, probably we'll have a better clarity. We definitely will start the discussion with the AMCs mid-February. But as of now, no AMCs have given an indication that what would be the behavior. But what I understand that, and I'm sure I think most of you would have done some kind of calculations, that the TER, maybe the TER cut and taking the GST out of the base expense ratio, probably that is neutral for many AMCs and for other, but for weak AMCs, it could be, I think, few basis point cut. And as Sanjay Bhai said, that 5 basis point of exit load is also out. This time, my belief is that the major of the AMCs may pass on the cut to the distributor, and that is what the feeling which we are getting, but no AMCs are communicated yet. So, yeah, there is no discussion, but the gut feeling is that the AMCs may pass on the cut to the distribution. The second point, what you asked, that the way when this earlier TR cut was there, how Prudent could manage the passing on to the distribution community. So we believe that when AMCs will pass it on to all their channels, including the MFDs, and definitely they might pass to Prudent for Prudent also. Prudent also will be able to pass it on to their distributors. So I don't think that this time we'll not be able to pass it on. Definitely it will be the same like what we did in past. So, but yes, I think let us wait for a few more months to get a complete clarity. But this time the experience would not be different compared to what it was last time. Second point, you talked about the MFD share in the Prudent system has come down. I think mainly because of Indus acquisition, because that 2,000 crores of AUM is added in B2C. Hence, you might be seeing that the MFD share is down. Otherwise, in the industry level, as Sanjay Bhai would have shared in the presentation also, last 1 year, definitely I think we have gained the market share. So it is not that we have lost the market share. I hope we have addressed both your question.
No, Sirish, he's talking about number of MFDs joining the Prudent.
So number of MFDs joining the Prudent platform is still the same. So if you look at last year, we added close to around 4,800 distributors in Prudent KT. And this year, we'll be able to add these many numbers in the Prudent platform. So we don't see that. I think the number of distributors joining Prudent has come down. It's the same. So there is no change. I don't know.
That's it from my side, sir. Thank you.
Thank you. The next question is from the line of Lalit Mohandiya from Equirus Securities. Please go ahead.
Yeah. Hi, sir. Good evening. Just 3 questions. So firstly, like in the insurance segment, like as you have highlighted that most of the health insurers have passed on the GST pressure to us. So like similarly in the last call, we mentioned that within the life insurance, only 30% was passed on. So is there any new communication from the other life insurers who have followed the similar suit and passed on the pressure to Prudent? Second, just on this non-GST distributors which you have talked about, can you please elaborate it in a little better way, like whether there will be any benefit to Prudent or not? And lastly, on the non-finance and on the non-MF products, so like on a sequential basis, we are seeing that it's currently ranging between 8 to 9 crores on a revenue run rate. So how should we see this line item for going ahead for next 2 years? That's the question.
Sirish.
So coming to your question, the last call what we spoke that in general insurance, most of the companies have passed on the GST cut to the brokers or Prudent. In life insurance, we said last time that around 30% of the insurance company or the business has seen the GST cut. I would say that I think there also we could negotiate some part of that. So the actual impact in the life insurance is not even 30%. It is lesser than 30% now. So in the month of December, we could renegotiate that cut with the same manufacturer. So as of now, I think at least till March, the cut in the GST component from the life insurance business is not even 30%. I think it will be less than 10% now. So that way, yes, we could save on that part. The second part, but this is till March. This arrangement, whatever we are right now, we are talking about is only till March. From April, as of now, there is no discussion, so we don't know that what will be the scenario post April. But till March, we don't see any major impact or major change in the GST now. Coming to the part, the non-GST partners or the GST cut, how it is going to impact Prudent, or little more explanation what you sought. So what used to happen that whenever Prudent, or earlier as Sanjay Bhai said that the commission used to be inclusive of GST. So whether the distributor was under the GST or out of the GST net, both of them were getting the commission rate including GST. So those who were out of the GST net, they were not paying the GST, but they were still getting the inclusive GST commission. So obviously, when Prudent has to pay the GST on a total brokerage, and there are many distributors who need not to pay the GST, obviously, I think the competitiveness or the margin of Prudent may be conducted. Now, from 1st of April, all the commission rates would be exclusive of GST, whether the person is under GST or not under GST. the commission rates would be exclusive of GST. So earlier, the person, non-GST person used to get X commission. From April, on the same business, he will get X minus 18%. So by default, the competitiveness or the margins of Prudent on that particular partner or that particular MFD will increase. So yes, I think that is a very, very positive point. Third, I missed the point, so I think Sanjay, if you can take that point, third point.
He's saying that we have a run rate of 8 to 9 crore on non-MF, non-insurance revenue. So what is your view on that, which is basically all other product other than the mutual fund, the insurance?
So basically, if you see the other products last few years, I think we started focusing very, very aggressively. One important product which was P2P. Now the revenue from P2P is almost zero. So obviously, we replaced the revenue of P2P through other products without impacting the fall in the other revenue. Here I would say that yes, I think our PMS book is increasing steadily, so that also contributes a bigger pie. FD business, the momentum is picking up, and there also the revenue is there. Loan against mutual fund, which we added last year very, very aggressively, and while we are talking, our book is almost, I think, 300 crores. So that is one more. Of course, the revenue would be little less, but obviously that is one more revenue item. I would say that is also contributing to our revenue. Broking side, as we communicated earlier, that the Prudent broking is now merged with Prudent corporate. So most of the clients, I think, who were in the funds bazaar, they were not able to trade on the stocks. Now they are able to trade on the stocks. Though the seriousness of our system also on the broking side has gone up. Obviously, I think the revenue front, it is not visible yet, but we strongly believe that broking also going forward will contribute better in our total pie. So non-mutual fund, non-insurance product-wise, yes, PMS, AIF, the alternate products are growing. FD is really doing good. Less last year added, doing good. Broking still will do better. SIF is a new product in the kitty. We categorize that under mutual fund only, but we strongly believe that going forward, SIF is going to become a very big product line for us. So that also we are very, very positive. Yeah, Sanjay, if you want to add any point.
Yeah, no, perfect, Suresh.
Thank you.
Yeah, ladies. Yeah.
Thank you. The next question is from the line of Dipanjan Ghosh from Citigroup. Please go ahead.
Hi, a few questions from my side.
I'm sorry to interrupt, sir. There is some background.
Dipanjan, आवाज नहीं आ रहा. I think आपको रुकना पड़ेगा 20 मिनट.
Am I audible now?
थोड़ा सा.
Yeah. So first question was on the commission payout part. If I look at the commission fee number to your revenues, that seems to be a little down compared to the normal run rate. So I mean, what really happened out there? So that's the first question. Second, if I look at the life insurance yield, when you mentioned, the impact has been contained at 10%, but on a quarter-on-quarter, yields are actually up. So is it a function of higher new business or some sort of product mix shift? If you can give some color on that. The third question is on the on the capital part. I mean, obviously you have highlighted a couple of times that you use some inorganic opportunity if it comes under the scope. So anything under the radar or what are you really focusing on out there? And lastly, one data keeping question, number of employees as of 31st December.
Yeah, so number one, you are talking about the commission payout looks a little bit reduced. That's mainly because if you look at as Sri's also said, I also said, because of Indus, our ratio in favor of direct has improved by about 1%, and that's the reason if you look at 60% or 65% of that must be the visibility of a reduced payout ratio. That's mainly because Indus add hua hai, and Indus is roughly about, finally Indus on an average basis has been about 1.2 or 1.2% something, right? So 60% of that will be 78-80 basis points. So you will see a 78 to 80 basis point improvement in the payout ratio. So that is number one. Number two, regarding the capital opportunity, because that's something which we have been looking for April to April like Indus, where I think the quality assets with the team and everything. So definitely we are looking for the lot of opportunity. Nothing is concrete as of now, and we are also looking for the experience of Indus. And probably after 3 years now, we are very confident that we'll be able to look for the opportunity further. Third is number of employees are 1,539. 1,539 as on 31st December, number of employees. And Sirish, if you can just touch base, he's saying that your LI yield has improved because of mix or what? What is the reason?
Yep. So basically, if you see, I think what we said is the GST impact, which was around 30% of the business in the month of October. By December, we could cut it down to 10%. So obviously, but still there is a GST impact of 10% when you are comparing the yield comparison. Second, I would say that the composition of business. So I think if you look at our composition till last year, it was majorly skewed towards the traditional plans. Last 1.5, 2 years, it is moving towards the Tulip product, which is term plus Tulip combined product, which is a new entrant in the industry last 3 years. And in that segment, of course, the yield is little lesser than the traditional plans. And today, Tulip is the biggest selling product in our system. Second, historically, we were not selling ULIP at all. Now, ULIP is also having some higher single-digit market share in our system. So mainly, I would say that the composition of the product has changed. That has brought down the yield. Second, I would say that still compared to the September, the yield, as I said, that compared to that month, still there is some pressure of around 10%. So both the reason combined, you can say that the yield is little lesser compared to the previous one.
So just one question, if I were to, let's look at your net MFT addition and split it between gross and attrition. I mean, given the competitive nature of the industry, I mean, let's say 5 years back versus now, are you seeing any shift between this, let's say shift in this attrition rate? That's also my side. Thanks and all the best.
More clear question. Yeah, sorry. So the clear question is, but I think you want to understand because of competition, are we seeing shifting of distributor from Prudent to other platform? That is the question?
Yes, absolutely. Yes.
Deepak, आपका question समझ नहीं पा रहा था.
Yes, so I think on the attrition part, exactly, I mean, what you pointed out.
Yes, is attrition or behavior change in the MFD?
Attrition in MFD, yes. Yes.
So basically, if you see, I think in the last call, I think last to last call, probably we had said that there are many platforms have entered in the industry. Obviously, since they are expanding the branch, the first target for their manpower requirement could be the existing platforms, whether it is we or the LJ. So last year, definitely we saw the highest churning, I would say, in our system, wherein the attrition was higher than our normal average in the last year. But I believe last few months or few quarters that attrition has come down, which has become now the average one. Obviously, by joining existing team member, joining any competition platform, does it impact our momentum? Yes, I think for certain few months, I would say that in that particular branch, we get disturbed. But we have not seen any major attrition of our channel partners joining the platform. Yes, we can say that those who joined Prudent platform might be recently. I would say that the joining was done by the RM who has joined the competition platform. The person joined with us in last probably 1-2 years or not scaled up the business, very small business. Few of them may have started experiencing how the new platform works. But those guys, anyways, I think never worked with us in an aggressive way because they joined recently, their AUM was not strong. So you can see that, yes, we have seen some small partners looking at these platforms because their commercial definitely at a base level commission would be higher. But can we say that we have seen the attrition of partners? The answer is clear-cut no. And that is visible in our business also. Even the new addition of partners is increasing. At the same time, if we talk about the simple parameter of the net sales or the gross sales or the new SIP or even the new health insurance business or the life insurance business, probably quarter on quarter, that number is becoming stronger and stronger. Probably this quarter was the highest ever net sales. This month, I would say that the highest ever SIP business we have done. This month again, that is, I'm talking about the January. So we are doing the highest ever SIP business, highest ever gross sales business, highest ever net sales business, highest ever health insurance, highest ever, second highest in terms of life insurance. So I would say that if that would have been the impact, our quarter and quarter business would not have grown. So the answer is no, we have not seen the great attrition, but yes, small level of partners, we have seen few guys joining them.
Correct, sir. Thank you for the detailed explanation and all the best.
Thank you.
Thank you. The next question is from the line of Saket Koda from Avendus Spark. Please go ahead.
Yeah, thank you for the opportunity. I have three questions. So the first question, Shirish, is to you to just check that out of the total AUM, maybe top 5 AUM where probably the TR will have an impact on their net yield and probably pass on the pain to the distributors. Maybe the smaller ones might not. So just wanted to understand maybe from an mix point of view, top funds contribute how much to total AUM, maybe top 5, then next top 10, and then residue. How much it contributes to total AUM, and if you think the larger ones pass on and smaller ones don't do anything to your payouts, then if you have done your internal assessment, likely impact on the yield. If you can give a bit of color there, it will be useful.
So top 5 AMCs contribute around 50% of our AUM. Whether they will pass it on that cut to the distribution community, the answer is definitely yes. They would pass on some cut or maybe the entire cut to the distribution community. Will it impact our gross yield? Yes, it will impact the gross yield, because when you have 50% of the AUM, I think if they see some kind of cut in the brokerage, so obviously the gross yield may come down. But whatever cut they pass it on to the distribution community, we assume that they will do it the similar for all their channels, because it's a regulatory change. So if they are doing the similar way to all their channels, we also will be able to pass it on to our distributors. So yes, it may impact the gross yield, but when we talk about the net margin, we don't see a challenge in maintaining our net yield margin.
But Shirish, on net yield, given you pass on to 65 to them, assume your yields come off by 1 or 2%, 1 or 2 bits. Then given 65% is passed on to your partners, then is it say that if it's 2 bits, then you will have an impact of 0.6, 0.7 bits on your net realization?
One important point, I think what we already highlighted, is the GST component. From 1st of April, all the rates are going to be net of GST. So obviously, on a historical book also, what we were paying to maintain our competitiveness, obviously we will see some benefit. I'm not saying the 100% benefit, but we will also see some benefit of those guys who are not paying the GST. Today, I would say that almost more than 50% of our AUM is contributed by those guys who are non-GST. Whatever we will be able to save, that will definitely compensate the loss in the yield.
Understood. So basically what you're trying to say that your payouts are little competitive because the individual guys who were not paying the GST, they were getting better yields. And now everyone gets net of GST. Maybe you can change your payouts in such a way that your net yield will not change. That's a fair understanding?
Yeah. It is a fair understanding.
Understood. Perfect. That clarifies my question. And second, I just wanted to understand, given the smaller guys will be better off in the new TR, is it fair to say that you will negotiate with the smaller guys on the higher rates?
I think it's difficult to say that we will negotiate the higher rates from the smaller guys. But at the same time, I would say that our competitiveness in the industry has gone up substantially. So I think it's too early for me to tell you that we'll be able to negotiate more or not. But at least the gap between we and the non-GST MFDs who in the industry, I think that will become wider, and it will either help us improve the margin or it will help us improve the competitiveness. So which way, how the AMCs will behave, I think only will come to know by April. But in either ways, I think we'll to increase our margin, or I would say that we'll be able to increase our competitiveness. So in either ways, I think it would be beneficial.
Understood. Got it. And the second question is that given in the current quarter, we had a benefit of some release of the withhold brokerage. Just wanted to understand, maybe on the current outstanding book, there will be still some withhold of brokerage. If you can assume everything gets released eventually, how much is that number you are sitting on at the current junction, whether it's a material number or it's meaningfully very small number to see a benefit, one-time benefits can recurring in the next subsequent quarters too?
So Sanket, the outstanding amount must be very large because the non-KYC cases, there are some 5 requirements for your KYC to be authenticated. And out of 5, SEBI said that one which was related to proof can be waived off and you can continue to do the business in the existing AMC, not into the new AMC. So if you have invested in, let's say, X AMC, then we'll allow you to continue investing there, and they have converted that status from a hold to registered, where the brokerage has been released. So one time, 1.4 crore has been released. There are many cases where probably still brokerage has not been released because we are supposed to complete the KYC process by meeting the customer, and that's a very tedious job. There is a back office team who has been regularly doing this exercise, but it is very difficult to tell me that how much will again come, but there is some amount. So probably either the rule has to change or we need to complete the KYC, and that's a regular process. But this one time is whatever we are supposed to receive has been received.
But I just wanted to check, given this is like a potential additional revenue or profit pool, just wanted to understand that number is meaningfully very big, like maybe running in 10 crores or something on that side.
I can share the number afterwards, I think. Let me just recheck number. We have been keeping that data with us. So I'll once check that number and I'll probably let you know separately.
Okay, understood. And on this brokerage release part, you also share it with the MFDs or you retain completely with yourself?
No, it is, I think, wherever. So I think the almost 50% was related to KYC of Karvi customer, which is not owned by anybody. So that has been our income. And rest 50% was for the MFD, where regular sharing will definitely happen to him. It is their business, and any amount which accrue related to distributors' business, definitely sharing will happen to them.
Understood. This is useful. And second thing, last question on amortization cost, which you told in the initial part, period has been increased from 10 to 15 years, both for Karvi and Indus, or rather Indus is 15, not like Karvi 10. Then is it fair to say that incremental amortization both from Karvi and Indus incrementally be 18.33 crores every year, right?
So I think that's a fair assumption. You are right. Yeah, I think you are absolutely right. Previously, we used to amortize 15 crore of Karvi every year. Now, from that, I think this amount should go to 18 crore. That is, you are talking about the annualized number, right?
18 crores, including Indus and Karvi. Karvi will be 10 crores and 8.3 crores will be Indus.
Perfect. Karvi would not be, I think you are 60 crore divided by 10. Roughly about 6-7 crore would be Karvi, and 6-7 crore should be, and there is another depreciation also. So I think the number would be about, say, Karvi, and so I can tell you the, Sanket, the written down value, WDV of Karvi was roughly about 65 crore, and 90 crore. So 90 crore was Karvi, and the 106 crore, 107 crore of the the Indus, because of the entire valuation mechanism. So I think it's roughly the same amount, and you amortize that over a period of Karvi would be 10 years from now onwards, and Indus would be 15 years. Another important point is that this 92.32 crore lakhs, which I told you, which is a part of finance cost, that is probably we'll amortize, we will take a P&L hit for next 12 quarters every year. So there's another about, you can say about 11-12 crore, which is going to be the consistent cost on P&L because of Indus.
Understood. This is useful. Thanks for your answers.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Anshuman from ICICI Securities. Please go ahead.
Thanks for the opportunity. So just to what you said on the insurance side, that life insurance have been only able to pass on around 10% to you, while themselves taking the remaining 90% hit. But on the health side, they have been able to pass on 100% to the distributors. This understanding is right as of now, as of March?
As of March, the understanding is right.
Okay. And secondly, on this continued market correction, we know the SIP numbers are good, etc. But any sense which you can share in terms of the overall outlook you see on chip demand, or because now it has been some time that the returns have been not that great for investors. What is the sense that you get as one of the top mutual fund distributors in terms of consumer sentiment on SIP?
To be very honest, I think this time the returns are not there, but SIP returns were there. So even last 1 year, SIP returns were there. If you exclude this last 1 month of volatility or the negativity, I think in SIP returns were there. To be very honest, this time we have not seen any major termination coming from the SIP. I think, yes, if you are comparing the termination ratio versus the last year, definitely it is higher than the last year. But last few months, I don't think that it is alarming till now. Even this month also, where we have seen the major correction in the market, we have not seen the increased termination. But yes, I think if this kind of market continues for a few more months or few more quarters, then definitely we may see higher termination and lesser new registration. And that is a human behavior. But assuming this kind of market, I think market revival after a few months or few quarters, I think as of now, to be very honest, we are not much worried. As I said, this month our SIP numbers are the highest. All the numbers are highest. We need to put more effort. We need to educate more to our investors and the distribution community in this kind of market. And that is what we are doing. So, but it's too early for us to tell you that whether we'll see the negative net sales or negative SIP or not.
That is helpful. And in terms of our numbers in January?
As I said, our numbers in January is the highest ever in new SIP registration, the highest ever in net SIP addition, the highest ever in net sales, the highest ever in health insurance, the second highest in life insurance. So that's what I said. I think in this kind of market, we need to up our action, and that is what we are doing. So, but yeah, we have not seen any worrisome signals in the market right now, or in terms of business.
Super, sir. Super. Thanks a lot. Thank you.
Thank you. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, I just extending on the previous question. Generally we had seen that the lump sum flows used to see some pickup in market corrections in the last 5 years. Whenever there has been some down cycle in the market, correction in the market, we've seen lump sum pickup. Are we seeing any such trend in the current downturn?
So historically, we have seen the lump sum pickup comes when the market corrects immediately. So that actually we saw last year. Right now, the market in a correction zone for almost last 12 months. So expecting that another new additional flow comes when in the month of January, I think, or the February market correction comes. As of now, it looks unlikely because there are so many negative news floating around. But as such, we have not seen that more and more people participating in the market and industry trend. Also, I understand, I don't have the industry number right now, but I don't see that kind of trend is visible in the industry when the investors sitting on sideline are investing in equity because of the market correction.
Okay. The other question was, in case the AMCs pass it on to you, the cut of 5 basis points, given the competitive environment in the way, quite a few of the new B2B2C players coming in the market and are ready to share 90%, 100% of their first year, at least the first year commissions. Do you think that competitive intensity will further increase and it will be a challenge for you guys to pass it on to your distributors, or you are pretty confident that the way you passed it on last time, you'll be able to pass it on this time also?
So I'm assuming that all these platforms also may have to pass it on if the AMCs cut their commission. That is one. Second is, even if they don't cut it, I think they have hardly anything to pass it on. Obviously, we can't take that kind of call that we are not able to pass it on. So we are very confident that we will be able to pass it on, at least with the percentage sharing ratio, at least.
Okay. And the last question is on the, again, mutual fund SIP market share. If we look at it, it's kind of stagnated now, in the last few months also. How do you think that, whether this is the direct competition that's increasing, or what is the real challenge out there to further increase our market share here?
So when you compare with the industry's market share, so definitely you always can see that the numbers could be stagnated. And one thing is very, very clear that I think when we always believe that direct will command increase higher share than the regular. So incrementally, direct is becoming more and more popular. So when you look at the industry's numbers are growing faster than the regular plans growth. So that is very, very clear. So when you compare our numbers in the industry's number, definitely I think we don't see that the growth in the percentage term when you compare including regular and direct, that number will grow very, very fast. Even if we are able to maintain that particular number in a scenario wherein the direct is growing much faster than the industry's growth, then itself I think it says that in a regular plan business, we have strengthened our position. But having said that, also last 1 year, we have increased our SIP share by around 18 to 20 basis points. So yeah, in this kind of scenario also, we could increase the share. But as I said, I think direct is definitely grow faster than the industry. And in that scenario, even if we can maintain the share, I think that is good enough for us.
What, according to you, would be the market share of direct SIPs in terms of monthly flows?
I don't have the actual number. Yes, Sanjay, I can tell better. Yeah.
Yes, it's roughly about 35% of the total book. That was, I think, last Cafe Mutual article, if I remember. So out of 31,000...
Book-wise is fine. And new SIP, the number is, I believe, upward of 50 now. But it varies month on month. I think Sanjay is talking on a book. I believe you are asking on a new flow.
I'm basically asking from the 30,000 crore of SIP inflows that the industry is getting on a monthly basis, roughly what would be the share of direct in it?
That is what I said. 1/3 of that is 10,000 crores. It is roughly about 1/3. 35% is from. You can say the number 35% comes from direct.
35% comes from direct. Okay.
Yeah. So our 3.5%, you should look at what Sirish is saying. That you should look at that 20,000 crore of. We have to look at our share in 20,000 crore rather than 30,000 crore.
Got that, sir. Thank you so much and wish you all the best. Thanks.
Thank you. A reminder to all the participants, you may press star and 1 to ask the question. Participants may press star and 1 to ask the question. As there are no further questions from the participants, I would now hand the conference over to the management for the closing comments. Over to you, sir.
Thank you everybody for attending this call, and me, entire management and Parth is available for any further clarification which you require. Thank you.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.